newsmakers, and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the US and China have agreed to a preliminary plan to ease trade tensions, which now goes for approval to the nation's leaders. Now, American negotiators say they expect issues concerning rare earths and magnets will be resolved.
We do absolutely expect that the topic of rare earth minerals and magnets with respect to the United States of America will be resolved in this framework implementation. That is a fundamental part of that. Also, there were a number of measures the United States of America put on when those rare earths were not coming. You should expect those to come off sort of, as President Trump said, in a balanced way.
In the past 2 days, China and the US teams had in-depth exchanges. Our communication is very professional, rational, in-depth and candid. Both sides have agreed in principle to a framework for implementing the phone call between the two leaders on June 5th and the consensus they reached in Geneva.
Let's get more now with Lizzie Burden. So, Lizzie, what we know about the discussions is that we're close, but we like details.
Exactly, Francine. We just want to see what they agreed on paper. We had 20 hours total of negotiations, and you had Jameson Greer, the US Trade Representative, and Howard Lutnick, the US Commerce Secretary, emerging after midnight to tell us that what they've agreed is a framework for implementing the Geneva Agreement, that 90-day tariff truce through which we're about a third of the way now. But as you heard there, essentially what they have agreed is that China is going to send more rare earths to the US, and in exchange, the US is going to roll back some of its export controls. So it's good news. They're not decoupling, but Greer also said there aren't more meetings in the diary yet. So we're not out of the woods yet. And I've been saying all morning, Francine, I think what we've really learned in the past few weeks and in London as well is the importance of export controls in this trade war. Donald Trump may love the word tariff, and indeed that court may have ruled that he can proceed implementing his tariffs, but Beijing has just shown us how much leverage you can wield using export controls. So now we look for a grand deal, and we know that they can take even 18 months to negotiate, as we learned in the first term of Donald Trump's administration, to get to that phase one deal. Could be a long road ahead.
It could be a long road ahead. Lizzie, we're also hearing that EU trade negotiations could actually extend beyond the deadline with Trump. So that's also moving in the right direction.
Exactly. It's the same story here, essentially. 2 weeks ago, you'll remember, it was said by both sides that they wanted to fast-track the negotiations, and Greer, Lutnick and Maroš Šefčovič, the EU's chief trade negotiator, have said that they're going to meet in person. But just this morning, our colleagues Alberto Nardelli and Jorge Valero report that actually Brussels sees that July 9th deadline for the so-called reciprocal tariffs as the best-case scenario for when the US and the EU can reach a deal. And Francine, that's because there is just so much to talk about. There's tariffs, there are non-tariff barriers, and there are so many critical sectors, whether that's chips or pharma or aircraft or autos as well. And so in the meantime, you've got the EU preparing its retaliatory measures. There may be a bit of cooperation on critical minerals, but it comes back to the same point. These talks could go on for much longer than Donald Trump bargained for.
Lizzie, thanks so much. Lizzie Burden there with a terrific roundup of the trade negotiations. Now, from trade to fiscal policy here in the UK, the Chancellor, Rachel Reeves, is set to reveal her spending plans for the next 3 years. Reeves will defend her fiscal choices in the face of a weakening labour market and declining political fortunes. Well, we're joined by Andrew Balls, PIMCO's Chief Investment Officer for Global Fixed Income. Andrew, as always, thank you so much for joining us. I mean, first of all, there's been a lot going on in bonds, right? I don't know whether it's the divergence between ECB and Fed, but where do you find opportunity in this kind of market?
Yes, so lots going on. Always interesting these days. Washington, D.C. in particular, keeping things interesting. You've seen markets price close to the end to the easing cycle for the ECB. We've seen an adjustment recently in Australia. We saw an adjustment earlier in Canada. So it's the UK and the US which stand out. Global markets, higher terminal rates, and I think in the UK case, that looks wrong to us. We would expect this adjustment over time. It's taken longer, partly because of some of the government policy, some of the inflation persistence. But our expectation is moving forward, we should see a pricing lower in terms of the terminal rates for the Bank of England. So the UK looks like a very interesting market to us. Okay, so what do you buy? I mean, is there anything that you buy in the UK market with conviction? I think the 5-year part of the curve looks a good place to be. Terminal rates close to about 3.5% in the UK. It could easily be 50, 100 basis points lower than that, given the growth profile. Of course, you need the inflation data to cooperate. You need the shift on the part of the Bank of England. The chief economist, Hugh Pill, of course, recently warning his concerns on stubborn inflation pressures. Our expectation is that will happen. You are seeing mixed messages, but cooling in terms of the labour market. So again, the Europeans got there first, but we think that the UK will catch up, and that looks like a good opportunity. Andrew, how much does it depend actually on what we have actually in the spending review? I mean, there's a number of forces, right? This is a small open economy. It's extremely, in the middle basically of trade wars, but there's also the government doing certain things. Yep. So I think that the trade war's somewhat less of an impact in the UK. There isn't a trade surplus, big trade surplus with the US in goods, so that's important. So we've revised down our global growth numbers, but less so for the UK. Fiscal, I think, the statement today is very important as a political event, and we'll see government priorities in terms of the political event. In terms of the market event, we've had the spring statement. We'll have the budget in the autumn. Those are the market relevant time. So unless there is a surprise, I guess there could be a surprise. Unless there is a surprise today, we actually know what the fiscal envelope is. This is more about division, the government's political priorities. So shouldn't be a significant market event, again, unless there's a rabbit out of a hat. How much do you worry about the U.S. economy? Again, it's some of the data points are weakening, but actually there's still a mismatch between surveys and data. So does the gap narrow? So when you have a shock, you would normally kind of think 3 to 6 months before you see that in the hard data. Right. So you're certainly seeing the weakness in the surveys. So it is now and over the summer that we should see the impact. We've revised down our growth forecast a lot in the US. Markets don't like uncertainty, but business decision makers don't make uncertainty. And as with your reports there, it's kind of clear as mud exactly how this is going to work out. Equities have recovered. I think markets are pricing in a baseline which is something like 10% across the board tariffs, and then somewhat higher sectoral tariffs, something higher for China. And, markets don't like uncertainty. As you get clarity in terms of that baseline, you can price to that baseline. I think equities are priced to that. Given that the strong recovery we've seen, I would see the balance of risks to disappointment versus upside risk. But it will have an impact on growth. For the Fed, the labour market's going to be very important. The labour market over the summer is going to be inflation data this week, of course. But the labour market, I think, for the Fed, again, 3.5%, 3.4% terminal rate for the US, looks somewhat high to us. Given the scale of the uncertainty, you certainly can see the risks skewed towards somewhat lower policy rates. But I think the simple thing from our point of view, high quality fixed income, 5 to 7% type yields on a core bond portfolio. If you look at actively managed funds in an uncertain environment, making 5 to 7% on global bonds, US aggregate bonds is, very, very attractive, we think, in terms of the potential returns. Andrew, there's nothing funny about an auction going badly. Do you worry about auctions? We could see, treasuries, but also Japan and elsewhere. So the auctions have become a significant event. We have the 30-year. Japan is really interesting. The steepening of the curve in Japan looks very interesting indeed. Don't worry about it too much, just kind of deal with the consequences. The level of yields looks attractive. We would think the 5 to 10-year part of the curve in the US is where you want to be. Plenty of room, we've got the big, beautiful bill coming up, plenty of room for more risk premium to be priced in at the long end of the curve. So be in the 5 to 10-year part of the curve. Japan does look like an opportunity. The authorities there are going to need to reduce the 30-year issuance. The market, the Japanese domestic investor base doesn't need the same supply in terms of 30-year bonds. This is something we see in other jurisdictions as well. So you need the Japanese authorities to signal clearly the reduction in long-end supply. But given the extreme steepness of that curve, we see this as a good opportunity. It's a trade. It's not a long-term investment, but a good opportunity in the 30-year part of the Japanese curve.
Andrew, I know Elon Musk apologized or said he went too far in some of the tweets, but bottom line, he was worried about the big beautiful bill and what it does to fiscal. I mean, do you share concerns?
So when you look at the long-term, outlook for fiscal balances globally, the US does stand out. US, France, Belgium actually stand out as a long-term path towards much higher levels of debt. I think that in the short term, we're not going to see any shift, certainly under this president, and we have tax cuts to come. I think there is a longer-term issue. So for now, the 5 to 10-year part of the curve anticipate more risk premium at the long end of the curve. I think that makes sense. The thing in the US, again, contrasts with France. In France, tax levels are very high. Yep. It's going to be hard over time to address the issues there. In the US, tax levels versus history are not that high. So it's about political will. Again, I'm not sure this will happen in the next 3.5 years, but over time it should be relatively straightforward from an economic point of view to adjust the US fiscal outlook. It's just about the political will. And
overall, I mean, the market, gets jolted, or the auction, the bond market is kind of in a panic for a couple of days, and then it, gets composure back. Are you expecting this to just be the way we operate over the next 6 to 12 months? I think
the kind of the step back a little bit from the screen and don't fret too much about the noise. A year ago, the 10-year Treasury yield was 4.5%. Today, it's 4.5%.
Deep breath.
Keep calm and carry on. Now, it's an unprecedented, I think, environment in terms of the uncertainty emanating from the US for global markets. The politics is driving the economics and the finance. Often you think that finance will drive the political process, but it's the other way around at the moment. I think that there is the room for more risk premium in the long end of the curve. But again, if you can get 5 to 7% type yields on high quality fixed income, this looks like a very good position to be in, given all the uncertainties. We've basically halved our US growth forecast for this year. Hopefully the trade negotiations globally will lead to better outcomes, but they could lead to worse outcomes. So I think that the high quality bond portfolio is attractive return and good downside protection in the worst, in the event of worse than expected outcomes.
Andrew, thank you so much for joining us. A lot to go through there. Andrew Balls, PIMCO's Chief Investment Officer for Global Fixed Income. Now, coming up, some of our conversation with Steve Schwarzman, the Blackstone Chief Executive, on tariffs, deal-making, and why Europe, he sees a major opportunity for the world's largest alternative asset manager. That exclusive conversation up next, and this is Bloomberg. Well, Blackstone is planning to invest as much as $500 billion in Europe over the next 10 years, another sign of the continent's growing appeal to investors during a period of geopolitical flux. Now, in a wide-ranging interview, the chief executive, Steve Schwarzman, also spoke to us about AI deal-making and the impact of tariffs on the economy. The world's largest alternative asset manager is marking 25 years of operations in London.
We started here with no one. We now have 650 people here in our office in London. We're building a very significant new headquarters in Berkeley Square. That's probably going to be the nicest office building that's been built really since the wonderful Bloomberg headquarters here in London. So that's worked out. We're in a lot of different business lines. and we have a very positive view of the future here in Europe. We think we're going to be able to invest $500 billion over the next decade in Europe. We see it as a major opportunity for us. They're starting to change their approach here, which we think could result in higher growth rates. So this has worked out amazingly well for us.
Where do you see the best opportunities in the UK and Europe? Is it certain sectors? Is it certain parts of the economy?
Well, we see in real estate, there's always opportunity as you go through cycles. We've been looking on a global basis with very similar themes. With artificial intelligence, I see that Jensen Huang was here meeting with the Prime Minister at a tech conference and was talking about how the UK needs to invest more in infrastructure. Blackstone is the world's largest developer of data centers, and we're also the world's largest owner of data centers. So it's been a really core business for us.
It's been a pretty subdued year overall for deal making. So how do you approach monetizations, for example, at a time of heightened demand for liquidity from investors?
Well, we're in a cycle now where the markets haven't been accommodative to IPOs, and the strategic sales to other private equity firms are difficult because they're having difficulty raising money. Fortunately for us, we finished our money raising cycle, so we've got lots of money at the firm for these things. We're in an unusual position. But I think we sort of look at these things and say we sell companies when we think it makes sense. We've actually sold a good deal, surprisingly. It's because we have some very good companies with very good results. And the rest of it is involving putting more money into businesses to make them better.
What have you seen since Liberation Day in terms of, deal making? You were broadly supportive of the tariffs by the Trump administration. Given the volatility, any second thoughts?
I think, what have we seen? We've continued to be buying things because we're long-term owners of assets, and when other people get somewhat disoriented or sort of pessimistic, we view the tariff situation generally as something that will be resolved over the next 6 to 9 months, and there are negotiations going on with lots of different countries. They'll happen at their own pace. But if you look at a world with an assumption that the tariff issues will find their way, and even if you end up with a base level of 10%, that'll be absorbed, with currency moves, with the shippers, manufacturers of product eating some of that cost, and the American consumer, eating some of that cost. You divide that 10% up 3 ways. It doesn't have a huge impact on inflation in terms of global growth. There may be a few tenths of a percent of change, but overall, it's something the world can absorb. And we'll be going on to be doing more buys of companies and other assets and sales as well.
Do you think some of these tariffs change the economy for a long time, that there will be consequences?
There will be consequences. It's meant to be positive for the United States, which is why the administration's initiated it. How quickly the good parts will happen, those always take a while, and you could have some slowing for a quarter or two, as we go through this. That wouldn't surprise me. But for us, as longer-term investors, who don't get quite as excited as people do who are trading securities on leverage on a daily basis, that's enough to make one nervous. For people like us, we look and say, okay, what's going to happen overall to economies? What's going to happen to the world economy? Slowing for a quarter or two in the great sweep of it doesn't make that much difference.
Steve Schwarzman, there, Blackstone's chief executive, speaking to me earlier. Now, Elon Musk says he regrets some of his posts about President Trump. A public feud erupted last week between Musk and Trump over the president's massive tax bill. Now, we're joined by Joshua Gallu from Munich. Josh, you've covered politics in the U.S. for many years. Where does this leave Musk's relationship with President Trump?
Well, you know, Trump is a very transactional personality. Right. So he has fought and mended fences with many, many people in the past. It depends on what that person has to offer him politically or otherwise. So, you know, this was, of course, in the fallout was spectacular, as many people had predicted it would be. And Musk has a lot to lose. So when he went to the mat with Trump on social media, there was it seemed somewhat inevitable that he would eventually have to back down with the amount of government contracts and exposure that he has to the government. And you combine that with the willingness of Trump to sort of never back down in that kind of spat. And, you know, what happened. But I think that, you know, Trump has shown in the past that he is willing, when there is a deal to be made or something to be gained, he is willing to go back to the mat.
So, and meanwhile, in L.A., the city also imposed a curfew overnight as protests stretched into a fifth night. What's the latest and what can we expect?
Well, that situation has escalated quite dramatically over the last few days. Of course, we now expect Marines to be on the streets as of today, and that will bring the number of troops to a very high level. There's a curfew, as you just said, that the mayor has imposed. And this is really a high-stakes conflict here, politically and also just in terms of the nation's view of what's happening over time during the Trump administration. So, you know, the Gavin Newsom, the governor of California, has sued to stop the use of National Guard, and that we'll see what happens in the courts.
Great, Joshua. Thank you for the terrific briefing. Joshua Gallu there with the very latest from the U.S. Coming up, the UK Chancellor sets out her spending plans for the next 3 years. We'll be speaking to the Resolution Foundation CEO on what we can expect. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Now, the U.S. and China agree a framework deal to ease trade tensions, ready for sign-off by Presidents Trump and Xi. Elon Musk says he regrets some of his posts about Donald Trump last week, saying, quote, they went too far. Plus, the UK Chancellor will defend her fiscal choice and announce billions of pounds of infrastructure investment in her spending review. Now, more on that story now. The UK Chancellor, Rachel Reeves, is set to outline how £600 billion of annual spending will be allocated across departments over the next 3 years. Now, this includes a £300 billion uplift for areas such as healthcare, education and transport. In a bid to draw attention to the rosier parts of her spending review in recent days, the government has trailed announcements, including investing £14 billion in Sizewell C nuclear project, £86 billion in British science, and committing £15 billion for new transport infrastructure across the North and Midlands of England. Now, the government's approach to public services have come under scrutiny, with the tax burden at a post-World War II high. Well, for more on all of this, we're joined by Ruth Curtis, Chief Executive of Resolution Foundation, and Dan Hansen, Chief UK Economist at Bloomberg Economics. So thank you both for joining us. Dan, get us started. I mean, this is exciting, but actually not really. I mean, I was just speaking to Andrew Balls, and he was like, look, it's not a market event like the budget is, but it gives us an indication of, I mean, we could see surprises, and it gives us a good indication of what the Chancellor is thinking and seeing.
Yeah, I think that's right. I mean, no one expects there to be any extra borrowing announced today. Of course, there's always a risk that happens.
But they would have briefed us.
You would hope so. But, we're not short of surprises on fiscal policy here in the UK. So but I think, the base case is we're not getting any extra borrowing. So it's about divvying up the pie. It's about on day-to-day spending. The big question is around basically how big is the health budget going to be and what does that leave for everyone else? And I think on capital spending, we've got a lot of information there, but that's going to really be around the government's growth story. Where is this money going to go? We had in the spring statement, or the spring forecast, I should say, this big, relatively large increase in defence spending. That's taken up a bit of a chunk. So it's how they apportion the rest of that capital investment budget. And then really about the narrative around growth, because that's really what this government has said it's about. Yeah. But we're waiting to see the sort of spoils of that effort.
Yeah, and Ruth, and welcome to the program. I think it's also to understand actually what kind of government they want to be, right? So it's the vibes that they're going to give. Are they more capitalist? Or are they more labour-leaning?
Well, exactly. And as you say, it's not a market event in the sense of borrowing, but it's really important for the country because it's really deciding of this quite significant increase in public spending compared to previous plans that the Chancellor penciled in. How is she going to prioritise that? And because the spending was quite front-loaded, so we've had quite rapid growth in public spending over the last few years, but the growth rates for the period that this spending review is about are a lot tighter. She will face really tough trade-offs, exactly as you said, between health and other areas, and even within her expanded capital budget. So we'll learn what she really cares about.
Ruth, the world's changed, frankly, since Donald Trump came to power with tariffs, Liberation Day, whatever you want to call it, just a lot of turmoil. Is there anything that you think the Chancellor regrets or that she would have done differently with hindsight?
Who knows? But I think one thing to bear in mind today is the OBR didn't take account of any tariff action in their last forecast. So when we look ahead to the autumn, we'd expect that's the first time they take that on. That's presumably going to mean a downgrade to their forecast. And so we've heard a bit from the government about the improving economy, meaning they can afford things like winter fuel payment. And that doesn't really stack up with the sequence of OBR forecasts. Yeah,
and at the end of the day, again, when you look at what bonds are doing, this is like the fiscal reality is that it doesn't live in a bubble. It's faced with market movements on a day-to-day.
Yeah, absolutely. And if you look at global markets generally, I would monetary policy is always important. Of course it is for fixed income, but fiscal policy has become really important as well. And you just have to look at that. The UK has been an example of this. We had a big flare-up in 2022. We had a flare-up at the start of this year. Obviously nowhere near on the same scale, but people were talking, Trust 2.0. It didn't prove to be the case. But if you look at the US as well, there's significant interest in what the Trump administration is going to do on fiscal policy. So the UK is a price taker in global markets. So basically what happens in the US feeds across the Atlantic to the UK bond market. And the OBR, as Ruth said, takes that on board. And there is a big question not only about where we will be with interest rates, but also about the outlook for the economy, and particularly, I know it's nerdy and in the weeds, but what they say about productivity growth, how fast the economy can grow in the medium term. Because if they decide to make a change to that, it will mean a big change to the government's fiscal outlook, and the OBR has been very optimistic about that. So that is a big risk the government has hanging over it going into the autumn.
Yeah, and I want to ask you a little bit about growth in a second, but also she needs to make a difference for lower income families that have been struggling for so long.
Yeah, absolutely. And when you look through the spending review, because spending is growing in real terms, despite all the talk of austerity, when we look at the benefits in kinds to households, we think those will rise through the spending review by about £250. But what that delivers in terms of public service outcomes will depend a lot on how she allocates it, on things like how much public sector pay is eating up that money.
Yeah. But Ruth, overall, is this just tinkering? Because there's not a huge amount of money. Like actually in whatever she does, and we'll talk about growth, but defense, there's just nothing radical that she can do.
I mean, what her plans involve is basically the state saying roughly the same size, right? Departmental spending is basically goes up a bit and then down a bit and is constant through the forecast. So on the other hand, a government can't really do more than that unless it does want to put taxes up. So I wouldn't call it tinkering. In some ways, she's looking at the books bottom up and saying where her priorities lie.
I like your piece, Dan, that you wrote with Anna Andrade, looking at basically, this is another chance for the government to show that they're serious about growth. Mm-hmm. Is this well understood within government, that they're also speaking to, I guess, investors and international community?
Yeah, absolutely. I think it is, because it goes back to the point in the previous question, is that there is a relatively fixed amount of demand for an increasing amount of supply, a fixed income going into the market from governments. All governments are running very wide deficits. So you have to make the case to global investors why you are a better case than another country. And that's around saying, is this investment going to give a good rate of return? I think the challenge the government has, and we all know this, is that investment spending just doesn't yield return very quickly. Right. And over a 5-year period, when you're worried about getting re-elected, that's a really big challenge. We all know it's the right thing to do, but the economics doesn't necessarily stack up with the politics in that world.
But another 4 years in charge feels like very stable compared to other parts of the world.
It does. But it's also a very unstable, I would say, political environment with what's going on with reform and the like, where Labour are really focusing on trying to sort of sort that and stem that flow in the polls. You've already seen them announce something on migration, which is a real pivot. So there are the things that they came in and were voted in to do, and then there's the sort of day-to-day, as Ruth said, global trade war. Yep. That's something they're going to have to focus on. And I think the past few governments particularly have fallen foul of having to just deal with the events of the day and just put to one side the sort of longer-term strategy. Hopefully today we get a better sense of that over the next four or so years, particularly, as I say, when it comes to investment spending. Yeah,
affordable homes is really, part of central to their strategy. Will they manage?
So what we've heard this morning is a sort of dramatic total number of 30-something billion on affordable homes. When you look at what that is per year, it looks like it is, and we'll get the detail later, about a doubling in spending on affordable homes compared to the last few years. It takes us to about 2008 levels. So it's both a big increase in spending and I think still questions about how much of that 1.5 million homes will be in affordable homes versus other kinds of housing.
I mean, I live in southwest London, and actually they're building like crazy. And this is really the council, over the last 5-6 months. I've never seen building works go up so fast. Defense, I mean, this again is a huge, there was a NATO summit. How much, spending could they do on defense?
Well, I think the starting point is that we know they're going to 2.5% of GDP by 2027. There's this aspiration to get to 3% at some point in the next parliament. They've been back and forth about whether it's an ambition or a commitment. It's possible. There's more detail on that set out today, how we get or when we might get to 3%. That might be, one of the sort of, as they say, rabbits coming out the hat. But there will still be this big question about, we've got the NATO summit later this month. There's still that gap. And if you're thinking about the holes in this plan, the fiscal holes, defence is a big one, and the sort of usual one that everyone talks about is unprotected government departments, the real terms cuts in departments other than, say, health, education and defence. And they're the two fiscal holes that people will begin to talk about, and knowing the British press, it will quite quickly turn to at what point taxes will have to go up and talking about how difficult the autumn budget's going to be.
How can she manage that? Can she manage that?
Well, so it really is, as Dan said earlier, all about how quickly she grows the health budget. So the long-run growth rate for the health budget is about 3.6%. If she were to do that, then there would be real terms cuts elsewhere. It is possible for her to contain that to more like recent growth rates, and then she could avoid, apart from the aid cuts that we know are coming, real terms cuts elsewhere. But obviously, just maintaining your budget constant in real terms is not necessarily enough to deliver huge ambitions for public service reform.
Ruth Curtis, Chief Executive of the Resolution Foundation, and Dan Hansen from Bloomberg Economics. Thank you both for joining us. Now, Inditex shares tumbling this morning after the Zara parent company reported a muted start to the second quarter in its latest earnings release. Charlie Wells is here with an update. So, Charlie, what does today's report mean for Inditex?
Francine, well, the market really is not liking what it's seeing in this report. Inditex is the worst performing stock in the Euro Stoxx 600 this morning. And really what we saw in this report was a slowdown in revenue growth. This has been a trend over the past few quarters. And really this report did not show a divergence from that. We also saw a tepid start to this all-important summer sales season, so slower than last year despite growth on that front. And what is notable here in Inditex is in this earnings report, they talk about a hit of 3% to revenue on FX concerns in the year ahead. So this is a concern that a lot of European companies have had because of the strength of the euro, given this FX headwind. So this is panning out for Inditex. And what this report, bigger picture, shows overall is this narrative that we're seeing in the fashion space. After all of these earnings report, investors have sort of been struggling to put this together. And what we're seeing here is really three tracks. So on the upper end, on the Kering front, on the LVMH front, you're seeing pressure. On the Inditex front, on the H&M front, sort of on that lower end, you're seeing pressure as well. But it's really in that mid-market, in that sort of Ralph Lauren, the kind of Michael Kors, the Kate Spade category. That's where you're seeing a lot of success as consumers trade down, but are still looking for a little bit of luxury, but at a much more kind of valued price point.
Elsewhere in retail, Nintendo reporting a sales record for its new Switch 2 console. What do we know?
So we know that in just 4 days, Nintendo managed to sell 3.5 million of those Switch 2 consoles. Now, this is all important for Nintendo because they derive some 90% of their revenue from Switch. So this is a debut that is very important for the company to keep that revenue growth going. It's been 8 years since they launched their Switch, and actually, those sales figures in just 4 days are better than what that original Switch managed in the first month when it debuted in 2017. So this is important for Nintendo, but it's also important for the gaming industry as they try to look at trends. These consoles are important not just for the hardware itself, but for the software, and this sets a tone for the gaming sector. So competitors, including Sony, including Microsoft, are going to be paying a lot of attention to these sales figures.
Charlie, thanks so much. Charlie Wells there with some of the retail companies. Now, coming up, we're in conversation with Joe Davies, Vanguard's global chief economist. We'll get his outlook on the economy, but we'll also talk AI and the megatrends affecting investing. That's next, and this is Bloomberg.
It's not easy to say that before we know how the end game will look like in terms of the tariffs. And it's not only US, Europe, it's also China and the rest of the world. Trade is a very complicated thing because whenever you put some kinds of the barriers to a free flow of goods or capital, then there are trade aversions. So we will have to see how it all ends.
That's Boris Vucic, Croatia's central bank chief and ECB governing council, speaking exclusively to Bloomberg. Now, the turmoil that hit markets after President Trump's Liberation Day tariffs may have faded, but uncertainty continues to worry investors. A deadline for increasing the U.S. federal debt ceiling is looming. Trump's tariff exemption ends in under a month, while concerns are mounting about the implications of Trump's deficit hiking tax bill. Well, we're now joined by Joe Davies, Vanguard's global chief economist and global head of the investment strategy group. Also, newly minted author, a new book that came out, Coming Into View, How AI and Other Megatrends Will Shape Your Investments. I have it here, Joe. It's a great read. It's a short read. I urge everyone to pick it up. So congratulations on the book. I mean, this goes down to, it must have been a difficult book to write because it's actually right on the money on what's happening now. So you have to make it, long term, but also focusing on some of the quirks that we're seeing.
Well, again, really, the focus next 3, 5, 7 years. Yeah. What I think I'm proud of is that it's a data-driven framework. So this is not just my qualitative assessment. Maybe I'm pessimistic one day, optimistic the next. But ultimately, it is a tug of war. It will be the economic investment landscape the next several years for every country between AI and the deficit spending. So I think what we saw last month, concerns in the U.S., in the U.K. last year, is a glimpse of one potential future.
Yeah, and this is what fiscal concerns.
Yes.
And that fiscal concerns are just not being taken seriously.
Structural deficits matter. And structural meaning they're ongoing, they're chronic, and they don't look like they're going to stop. And it's important to calibrate that. When you do that, they raise inflation expectations at the margin and induce the central banks to try to fight it. Now, you can extend that dynamic or avoid that dynamic, like the United States in the 1990s, if you get technology to kind of bail you out. And that is the horse race and the tug of war that I talk about.
Joe, what I don't understand at this point in time is that we talk about, there's moments in stress in markets,
yes,
and we talk about shifts and everything changing on the New World Order, but we're not really seeing it in markets. And is that because it's too difficult to compute or to price in, or is it because they're waiting for some kind of event?
I think it's both, Francine. It's actually a really poignant question you have. I think there's a lot of noise in the near term.
Yeah.
There's also, it's tough to detect shifts until you see more and more data and evidence. Think of the late 90s. And so AI, we know, more likely than not, it's going to be transformative, but there's still doubts. There's like, well, what's it doing for healthcare? What's it doing for finance? And so you have always healthy skepticism. But again, what I think investors should try to see is that there is very likely to be a fork in the road in some of the macro dynamics. And it's not to be alarmist, but how can you think about orienting your portfolio? Because the markets are certainly not prepared for the economic diagnosis that we have.
Okay, I mean, treasuries are safe.
Yes.
Until we ask ourselves if they're safe.
Yes.
Again, does this go to structural reforms? Is it fiscal? I mean, this is what your book will try. Your book tries to also tackle head on, and what you do day to day.
Yeah. Well, and again, we were very proud. We spent a lot of time the past 2 years. We were among the first firms to say, listen, interest rates were likely to be permanently higher 2 years ago because of some of the structural deficits building. It's what's called higher R star. They don't need to continue to rise if you can have some of these growth thrusts. But again, that's where this tension is. Fixed income will still, again, the bonds are back, and that's been a theme for us for 2 years. But the fiscal dynamic bears watching, and there's ways that you can navigate it. There's actually greater risk in the equity market in the U.S. from the deficit dynamic than there is in the bond market.
I mean, you also argue that basically you need this AI revolution to get us out of the debt problem, because I guess if you grow to buy time, because of productivity.
Yeah.
But how do you look at AI? Because it could also, you could lose a lot of jobs. It could transform an economy, not necessarily for the best.
So in our diagnosis, roughly 20% of the occupations will see significant job loss. That's good for productivity, it's tough for disruption. More industries than not, however, will actually see more augmentation. Think Copilot. That was more like the personal computer. It's still early in our J-curve. There's also really eye-opening investment ways to play it if you think of the technology cycle in the second half. A lot of focus on the Mag 7. The smart money, in my personal judgment, is outside of tech if AI is going to be transformative.
Where? In insurance? I mean, could it be like as far-fetched as insurance?
You start at the value funnel, so healthcare, finance, thinking some of the... Again, we saw this in every other technology cycle. There's the AI production.
Yes.
That's a lot of some explosive growth. What we have to look for is the AI consumption. If it's going to be transformative, general purpose technology, tell me how profitability outside of Silicon Valley is going up. If it hasn't gone up, then we're talking about social media effects, which is close to zero.
I mean, it's my understanding. I mean, I had this great conversation actually with the founder of DeepMind, that's now owned by Google, and he was saying it's too early to say who the big winners from AI are.
Yes.
So how do you, understand who the second and third round effect winners are?
Well, that is tough to diagnose. I can tell you we're probably, forgive the American analogy, we're in the third inning of a 9-inning game, which is why it's
baseball.
Not baseball. So apologies to all the cricket fans. But again, it's still too early that it will be transformative, but that's where it points to. And so there's ways to navigate this. I would tell you, though, diversification, if you're sitting in the U.S., has been a tough argument to invest outside the U.S. Our analysis clearly points in that direction.
What, just for diversification? So it's almost a natural hedge.
Again, with this tug of war, we are effectively saying there's an 80% probability in the next 5 years that U.S. exceptionalism is over. That's a pretty bold statement, given our analysis.
When you look at markets, I mean, is the bond steepening trade to consensus at this time?
I think so. I mean, I think what you have to think about is what is the Federal Reserve or the central bank's reaction function to this? If we know the structural deficits have some push-up on inflation, certainly the long end of the bond of the yield curve, but the UK and the US, we know from our analysis, it's modestly put up inflation expectation. That brings central banks into fore. And so I think what you're talking about is tension over the yield curve between fiscal spending and monetary restraint. That, I think, is thematically what the environment we have already started to enter and will live with for the next several years.
Yeah, I mean, speaking of several years, the AI, there's, again, a lot of question marks on whether it does buy the U.S. time.
Yes.
Is there, in terms of timeline, when do we find out whether this experiment is actually
that's
good
the
or not?
big question. So I'll put a range. I'm going to use my hands. I'll put a range, but I will answer the question. Our analysis is rough. It's not on today's doorstep. But if you look out 2028, 2029, 2030, you have to have structural deficits roughly 8 or 9%. We're not there yet. But we're not that far away. So I'm not going to be alarmist. We are not talking about material further spike in interest rates in the United States in the next year or two. That would be a surprise to me. But these pressures are building.
And productivity, I mean, I've been talking about the productivity puzzle, I feel like all of my lifetime.
Yes.
Does it really get resolved with better use of AI?
We will know in 3 years whether or not AI is more transformative or not. It's not just going to be an automation front, Francine. We got to talk about new industries. So what I'm looking for is what are the new products that are coming out? Because at that point, we'll start entering the same period of time where the computer, the transistor, or the combustion engine, you started to see those knock-on effects. If we don't have the knock-on effects, then we're talking about more marginal boost to growth, hence a little bit more pressure on the fiscal side.
But so what's on, to get those knock-on effects? Is it, because I've heard, it's basically every employee being able to program an app to help them with what they need.
Yes.
Is that the big gamble?
It's that, but I think there's even more. It's what new industries or products are created. So I'd be looking in healthcare. I haven't seen much new medicine or treatments. The human researcher is in the loop, but what additional insights as a power tool did it help? You got to look at energy, and you got to look at finance, what new products. So again, that's areas I would be thinking about. Education, areas that are high cost and tough to serve for throwing people at it. Those are the two areas that if you're going to be transformed, that's where I would be looking. I'm just not smart enough to figure out what those products are, but your listeners could know.
Joe, I mean, you have basically scenario 1, scenario 2.
Yes.
Again,
it's not the
probability is is it one or the other?
Right now, it's roughly 50 to 40. Yeah. 50 being the AI is enough to dominate for a time the deficits. But that's pretty bold. What I said is that's certainly less than 20%, that we're going to get the consensus view, which is the Federal Reserve and the IMF forecast. It's tough to generate. You either have deficits push up inflation and push down growth, or AI does the exact opposite. It's just tough to generate the middle narrow path.
Yeah, where do you see China right now?
China has the same. The irony is, despite the tensions between the U.S. and China, they actually have two very powerful similarities. Both are leading by far every other country from AI, and both have deficit and aging issues. And so the dynamics in China are very similar to the U.S., despite differences across all other spectrums.
If there's one thing, I mean, we've heard a lot of, maybe for your day-to-day job, we hear from a lot of Federal Reserve governors that they're just in a wait-and-see situation because they worry more about inflation than labor market.
I think it's smart. It will change if they really see cracks in the labor market. We have cooled a lot in the labor market, but if we see further evidence of weakness, we have some modest easing priced into our baseline in the second half of the year. I think you have to see another step down in the labor market. We could see that later in the summer. We've had a lot of uncertainty hit the global economy over the past 3 months.
Why haven't we seen these really bad surveys translate into the real economy yet?
Well, it's two things. One is the resilience, and the other is, again, we were still out of balance and still working it through. But again, your service-based economy, it's tough to generate a recession. I think that's sometimes lost. Manufacturing is still struggling, but 80% of the economy is service-based.
Joe, thank you so much for coming on. Joe Davies there, Vanguard's global chief economist, global head of investment strategy, and author of this great book, Coming Into View. Now, don't miss the launch of our new show, Bloomberg Tech Europe. That starts this Friday. Tom McKenzie, of course, fronting that 6:30 a.m. London time. Up next, Bloomberg Brief, and this is Bloomberg.